Have you been using a covered call strategy? In a covered call strategy, you actually have the ability to generate income on a weekly basis, monthly basis, or quarterly basis, depending on which exact strategy you're using. In today's video, we're going to be breaking down the Goldman Sachs NASDAQ 100 Core Premium Income ETF with the ticker symbol of GPIQ. Now, this is a very compelling opportunity to invest into the NASDAQ 100 while having exposure to those very big high tech stocks and with an added benefit of Goldman Sachs. And it does have covered calls, which is super interesting. So what they're holding, they are offering the calls on, which is interesting. So let me break down exactly how this works. Then I want to break down some of the performance that we're seeing out of this. Now, it provides exposure to the NASDAQ 100. For me, I personally own the QQQM, which has that same coverage within the NASDAQ 100, owning all of the stocks while generating income from those positions using a covered call strategy. Now, we have seen this from now Goldman Sachs. We've seen it from Roundhill. We've seen a lot of companies that are starting to use this covered call strategies, holding the stock, selling the call option, and collecting those premiums. That is the way it is able to not only see the stock appreciation, but we are also able to generate a lot of income, passing the income on to its investors through monthly distributions. Now, this, by selling those covered calls, it generates a steady cash flow. If the stock is up, if the stock is down, it is still going to generate that cash flow, reducing the volatility in there, offers some downside protection where even if the market does have a pullback, like we just seen with the NASDAQ 100, you are still going to be generating income. Now, when we start breaking out these top 10 holdings, Apple, Microsoft, Nvidia, Amazon, Broadcom, Meta, Netflix, Tesla, Alphabet, all of the big names that we know in the NASDAQ. And the key to this is the monthly distribution. So versus just buying and holding the ETF itself, you're buying and holding the ETF that offers the additional kind of coverage with those covered calls. So it launched in October of 23, so it is relatively new, paid dividends ever since December of 2023, and has paid less than 40% per share in the last 10 months, 41 cents per share this month, 43 in the shares, and it has slowly went up. So roughly yield would be about 10.9% at the time of publication of this article. Think about that. The yield that you were getting returned with those covered calls was 10.9%. Over the last 2 years, thinking of 2023, 2024, we have seen a huge rise in tech. We're going to probably see it the rest of 2025 as well. Now, why does this make it a safe option? Now, it's a safe option because it is a combination of income and really protection that it provides, enabling those monthly distributions, which can go right back into the ETF, creates less volatility with really adding in that extra layer of protection from those market declines because you are still generating income. Now, the covered call lacks the movement or downside movement in really underlying stock positions. So again, if you see the market start declining, you are still going to do this. And it's also very safe for the monthly dividend payers that you want to have and that you want to carry. Now, on top of that, does it belong in your portfolio with ongoing uncertainty in the market, looking at tariffs, geopolitical tension, recession fears? It offers the investor the opportunity to have a significant amount of income that is coming in with a potential price appreciation of what we're holding with the NASDAQ 100, with not as much downside or having that benefit of downside protection because of the higher yield that we're seeing in the ETF. So let me hop over. I want to break down and show you kind of what we're looking at here and what this does look like. So looking right here, we're going to break this down. This is the Goldman Sachs, again, the NASDAQ 100 Core Premium. Whole mouthful right there, but the ticker symbol is the GPIQ that we see right there. So let's break this down. Looking at it right now, $45. So pretty low share price overall for an ETF. Holds 106 holdings. Now remember, that holds the NASDAQ 100. That is the exchange that these are on. It does hold the NASDAQ. P&E ratio, 31%. Now, when it comes to tech, we know the P&E ratio is always going to be a lot higher. Fees and expenses, which again, if you're looking at a 0.29 or a 0.35, you have to think since the inception, it has run about a 10%, which is kind of crazy when you think of how much this has been returning with those covered calls. Now, looking at the growth on $10,000, you can see right here, we're at about 13. So you're looking at a pretty good appreciation, about $1,500 or about 15% on the 10,000 that was there. over the last, or since inception, which I believe was right here in October of 23. So when we start looking at the return, negative 2%. So think about this for a minute. When you look and in comparison to the NASDAQ is a lot further down than that 2%. 3 months were even positive here. 6 months were up 8.28% in the last 6 months. 1 year, 16.07. So over the last 12 months, doing incredibly well. Then we look since inception, it is up 25.86%. So think about that for a moment. So we have roughly 2 years since inception of 10/24 of 23. We are looking at almost a 26% upside because, again, even when it is down, when we see that tech pullback, we still have the ability to generate income on this through those covered calls when we're holding what we're holding. So the NAV comes in at 36.43. Market returns, you can see year to date 0.17. Looking at the annualized returns, this is where it gets pretty interesting. Since inception, about 25%. 1 year, again, 16. Premiums and discount, you can see we had a little bit right there at 47, 0.01, 0.025. So not a lot of change right there. 12-month trailing distribution, 10.3%. That is incredible when you look at the distributions. Now, of course, this 10.3% is what is offsetting those the pullback that we've seen in the tech sector. And you can see that dividends are being paid on a monthly basis. So you're kind of getting both sides of having something like the QQQM. You're having something that is very NASDAQ focused, very tech heavy, with the flip side of having the premium, the income that is coming up on a monthly basis, meaning, again, you're generating a lot more when it comes to the distributions that you're receiving from this on the upside. Now, majority of tech companies do not pay a dividend. This is just income generation that is coming from those covered calls. Now, looking at our allocations, again, very similar to what we see with the NASDAQ. We have Apple, Nvidia, Microsoft, Amazon. Looking right here, that's roughly 50%. You can see others drop into 52%. Most of it is going to be the tech side because it is based on the NASDAQ 100. And if you're unfamiliar with the NASDAQ, it excludes all of the financial stocks. And that is why it picks up a lot more tech stocks. And it is also market weight heavy, meaning Apple right now is the biggest company in the United States, holds 8.88% of Apple because it is market cap weighted, meaning it is going to hold a lot more. Now, looking at our sectors again, it does not include finances. Financial is taken out of the NASDAQ. So we have information technology, communication services, consumer discretionary, some staples, some healthcare, some industrial, which does make up it's in its entirety. So overall, guys, it's pretty interesting to see how they can continue to create these new ETFs. I mean, we're going on 2 years of this. But you can see, even looking at the consistent dividends that they're offering, not only are you seeing the growth of the NASDAQ 100, but you're also seeing a lot of the performance that you're getting from the covered calls. This is a strategy that we have seen a lot of companies that are starting to do with the covered calls. And I want to break it down. I want to hop over. Let me hop out of here. And I want to look at the NASDAQ 100 and just see kind of the performance. What exactly does it look like over kind of a similar amount of time? So looking down here, I'm thinking Invesco is probably just going to be a place. Some of these, it's harder to find where exactly it is, or looking at the ticker symbol, especially when you just look at something like the NASDAQ. You can get a ton of different articles. We can even do performance. That way we can kind of break it down, get the latest on some of these. I think this might have been, Capital Group again pops up. Invesco, NASDAQ 100 right there. Let's look at Yahoo right here. This is the QQQM. This is the one that I actually do hold. So looking at the performance that we're seeing in here, you can see 24, 25%, 23. Look at that. QQQM, 55%. 2021, look at 22, down 32, which is kind of crazy. But even looking, year to date, we're negative. Looking your month to date, we're negative. Even looking at the 3 months, we are negative in the entirety, meaning that you are seeing a lot more performance out of something like this when we actually stack the performance. Looking at it being positive in the 3 months, I mean, you're 6 months, 8.2%. Even on the year, we're at 16. We're here on the year. I mean, we're pretty even. So 16 here on the year. But again, it seems like some of those, 1 year it shows right here is last 12 months, 8.45. So 1 year right here is looking at 16.07. So again, a little bit of a variation overall when you look at what the returns are. and even year-to-date returns. So far right now, year-to-date, negative 5.9. This year-to-date is still right at that positive mark. Again, because of the calls that we are seeing in there, really making a big difference. So, all right, guys, so that is going to do it for today's video. Let me know what you guys think about covered calls. Again, I've seen a lot more companies that are starting to do these covered call strategies. This is one that I absolutely wanted to cover because they said with Goldman Sachs behind it, having the ability to go in there, invest in the NASDAQ 100, then pick up the covered calls. So the regular monthly dividends that you're getting in there, or the premiums that you're getting, really does make a big difference. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.